All right, welcome everybody. You have arrived at session number 5 of Let's Dig Deeper. So I'm going to share a little slide. Gosh, it's somewhat messy, but hopefully, I'm trying to get rid of this. So, all right, so welcome. This is session 5 of Let's Dig Deeper, which is our series for economic business development folks who are learning about cooperatives. And we've asked professionals in many different fields to kind of give you the inside scoop on how they look at and think about cooperatives. And today we are very lucky to have two leaders and professionals in lending. So we have Dami Odetola, who is a vice president of lending at the National Cooperative Bank, also serves on KDC's board, also serves on the board of the Local Enterprise Assistance Fund, which is Gerardo Espinoza's organization. He has been the executive director since 2008, and this is a fund that lends nationally. And I just learned yesterday, Gerardo is now on the board of the National Cooperative Bank. So they are each other's boss, and Dami's my boss. But what they're here for is to be total bosses of how lending happens to cooperatives. So a little bit of housekeeping. Let's see. Oops, that's not what. Okay, so I'll be putting in the chat the survey for the end. Folks who want to get certified, the way you certify is by filling out a survey for each of the sessions. And you can do that either by attending a session and then responding, or by viewing the session recording afterwards that we will send out and responding to the survey. And if you let us know how each of the 6 sessions were, then afterwards we will hold a kind of a going over what your plan is for disseminating some of this information among your networks, and encourage you to do that and send your certificate. So if you are interested, get in touch with anybody at KDC, me or Autumn or Hannah, who's been sending the follow-up emails, and we'll be happy to help you get that certificate. And this is our next to last session. The last one is going to be in 1 week. I see that the date is incorrect on the slide. So it's 1 week from today, June 12th, same time. So, and that's going to be a very interesting one on cooperative business transitions. So basically, how an owner can change the ownership of their business, either staying in the business or leaving the business, and have it changed to a cooperative ownership, either worker ownership or some other form of consumer ownership, vendor ownership, whatever. There's different models. So that'll be interesting. All right. So without further ado, I am going to stop sharing and turn it over to Dami and Gerardo.
Dami, you want to go first?
Hi. So thank you very much for having me, and thank you for also having my boss. So I must make sure that I'm behaving myself. I don't say anything that I'm going to get in trouble for. So Gerardo, just in case I make a mistake, please be lenient with me. And when I quote numbers, again, be lenient with me. I'm happy to be here, guys. Have a couple of things that I mean, I have a presentation. I think most times we get bogged down by sharing what we have, what I have prepared, or what Gerardo and I have prepared for you guys. But I think what I would want to start with is to, first of all, do a quick introduction, literally 10 seconds per person. And anybody that has a question or wants to share why they're here, that would be very helpful so that we can focus on, trying to get answers for you before we come with a presentation that is tailor-made. Um, so do we want to start? I'm going to start by passing on to the next person. After I do a quick introduction, I'm Dami Odetola. I've been with the NCB for about too long. And I serve on like a few boards in the co-op world and also in the not-for-profit world. I've been working as a BDO or business development officer for about the last 10 years or thereabouts. And right now, I work on the impact banking group of the bank. I am currently at a conference for Community Development Bankers Association, but when Noemi or Gerardo calls me, I leave what I'm doing and I run there. So that's Dami. I see Autumn next to me. So Autumn, quick introduction and whatever you want to get out of this, let us know.
Sure. Thanks, Dami. It's always great to spend time. Autumn Vocal on staff at Keystone Development Center as one of the co-op developers. Tuning in from Meadville, Pennsylvania, where I get to spearhead with some other folks here. Cooperation Meadville encompasses a real estate investment cooperative, a renting co-op and community land trust, and some other co-op initiatives that we're getting started. Artist co-op, dog daycare cooperative is new. So lots of beautiful things in our small town. Yeah, and we're coming to a point now where financing and access to capital and capital to access, someone gave me that framing the other day, uh, is the thing, right? To be able, especially in the work that we're doing, getting land, property requires capital. And so always hoping to learn more and prepare ourselves so that we're in a better position to finance the good work that's happening here.
Is there one thing you'd want to get from this conversation?
I'm really excited to learn more about Leaf. I know I've gotten to talk to you, Dami, about NCB and have plans to follow up with you after this for something anyway. So I'm excited to also learn about Leaf and the role that they play in the kind of financing landscape for cooperatives and how especially maybe new borrowers, new folks might be able to position themselves to kind of be best ready to be finance ready. Great.
Thank you.
Do you want me to pass it? You want to pass it?
Yes, please pass it.
I'll pass it to Scott.
Hey, I'm Scott Christensen. I work at the University of Maryland in supporting startups, across a lot of tech kind of businesses, and also ecology and kind of stormwater kind of businesses. I mean, that's a broad thing. We could talk more about it, trying to be quick. And so I think I'm interested in learning how, one of the things we do is always advising our companies on how to access financing. And, part of what I do is, support them in getting traditional like venture capital financing, but trying to explore the lens of like, how do we think about cooperative financing? What are the nuances you need to understand about cooperative financing in particular? And specifically in my case, I'm interested, like, a lot of these companies are a little bit more risky than maybe your traditional like a cafe or a already existing kind of business model. A lot of these have like different levels of risk, And so I'm interested, like, what are the financing options available for that? And it might not, and maybe there's no good answer there, but that's kind of how I'm looking at this.
Thank you.
And I'll pass it
Scott,
to,
you want to pass it?
I will pass it to Kendall.
Good morning, everyone. I'm Kendall Teague. I'm with Caroline County, Maryland Economic Development and Tourism. Just kind of reiterating a little bit of what Autumn had said about how access to capital is getting more and more difficult right now, especially in a rural area, having more options is what's needed. And, I've been trying to join all of the sessions to learn more about co-ops and ways that I can help some of our smaller businesses who have shared some interest in potentially working as a co-op, and what I can do to help support that transition. So I'm here on a just to learn.
And, Caroline, what does the organization you work with, what's the role of the organization?
I'm sorry, what is the what?
What is the role of the organization? What do they do?
So Caroline County Economic Development, we are a local government department, and we support the businesses here in our county. We are mainly agriculture, industrial, or agriculture, manufacturing, construction. We have a really great logistics hub here in Caroline County. So those are our main industry sectors. Really, though, the smaller businesses, the 1 or 2 person businesses who have grand ideas of expansion, it in some cases would make more sense for them to develop a co-op for the not just financial support, but also having more people involved to cover. Anyhow.
Thank you.
Mhm.
Oh, maybe we can pass it to Cynthia now. Cynthia, are you able to come off mute?
Hi, yes. I work with the USDA on a new program called the Regional Food Business Center program, and was, really interested in these conversations and these trainings because just has been it's come up in like several conversations that cooperative models may make a lot of sense for particularly farm businesses, but I just honestly know very little about kind of the legal tax governance implications. And so have just been really listening and trying to absorb, I would say, and see how it might apply for our centers providing this technical assistance to these farm and food businesses.
Great, thanks, Cynthia. Lacey, do you want to go next?
Hi, my name is Lacey Molesky. I am the cooperative developer at Common Roots located in Meadville, Pennsylvania. My coworker, James, I believe, is also on the call. So we do running cooperative, hopefully in the future start a maintenance cooperative, and also a self-help housing program we're hoping to get launched. So trying to learn as much from cooperatives as I can.
Great. And James, did you drop off and come back? Is that you?
Yeah.
With me?
Yeah,
Hi.
I lost. I had changed my name before, but yeah, then I got internet went out, and then I just jumped back on.
Great. Feel free to introduce yourself and say what you're hoping for in today's session.
I'm just really, like Lacey said, we have the renting cooperative. We're hoping to expand on that. The maintenance cooperative, we're a community land trust. Yeah, I'm just really like all these sessions, the night ones, these ones. I'm just, and meeting with Autumn and everything like that. I'm just really trying to learn the most I can about cooperatives so that we can better, make our model stronger and stuff like that. I know there's a lot of interest in the renting cooperative and stuff like that from other towns, cities, stuff like that we always get. So yeah, just trying to learn a lot so we can make a good, strong program and, share it with other folks.
Cool. All right. I think we've heard from everybody, and I'm so glad you're all here. If you're in a place where you feel comfortable turning on your camera, that'll be fun and be easier to be interactive. But let's turn it over to Dami and Gerardo. Go ahead, Dami.
So, Gerardo, I think, thank you very much, Naomi. I think the first thing that, the first request we got is from Autumn, who wants to know a little bit more about Leaf. So, do you want to quickly touch on Leaf and explain who Leaf is and what Leaf does?
Sorry, Dami, you would like me to talk about Leaf?
Yes. So, I think we should just take a couple of the questions that were asked.
Okay.
Autumn wanted to know more about Leaf. So once we do that, I can run through the presentation I have and talk about, what we look for, and then we can follow it up with questions. But I think we could take care of the questions first.
Yeah. LEAF is a community development financial institution, and if you are not familiar with the term, anyone is not familiar with the term, please let me know, and we'll take a couple of minutes there. Okay, so the LEAF was established initially to provide funding to worker cooperatives. And over the course of the years, we started working with other type of cooperatives like housing cooperatives and food cooperatives. And more recently, we have started working with community land trust as well. And as you can notice from these different types of cooperatives, what the community land trust is, what they have in common is a share ownership model. And also someone made a reference to governance and also the governance model that goes with each of these types of cooperatives and land trust. So that's what we do to try to provide financing and in some instances technical assistance, particularly on the financial side for this type of cooperatives. And even though most of the stuff is based in Boston, we work nationally. And yeah, so that's a brief description of what we do when we provide loans, different type of loans for different type of needs. And sometimes the loans is tailored to different types of cooperatives as well.
Autumn, any questions?
No, I'm thankful for the explanation. Glad to know more. Glad to know about your footprint. Thanks.
Cool. So I mean, the basic thing here is what do lenders, what are our perspectives about cooperative business? And I think most times, I think that is a little bit limiting on what co-ops are. For instance, what do I mean by limiting? Cooperatives are sometimes not full businesses, but most times, especially when you're going to a lender, you at that point are a full business, right? What you do is you're going to a lender to say, hey, we need to be able to borrow X amount so that we can pay or do or repair or do something. And at that point, you're doing it because you know that you're going to get money back to be able to pay the loan down. So we might be called cooperatives. The truth of the matter is we're no different from a typical business. What we do that is different is essentially what we do with the profits that we make and who owns us. That's that we do ethical things, we do things better than investor-owned companies, but we're essentially a business. And I'm going to quickly share what I have here. It's going to take 2 minutes. I'm going to go through it real quickly because I know that most of us must have seen one form of this or another. Once I can find the share button. And there's so many. All right, let me know if you can see my screen.
We can see it.
Okay, you can see my screen. So what is lenders' perspectives? And my first question is, are we different? Are we different from what we would normally see in a business? And I kind of like talked about the fact that I don't think we're different. I think we're close to being um, a typical business. What we are different in is our principles that guide us, number one. And then number two, what we do with our profits. So again, this explains it. This is why we are unique and better than investor-owned companies because we follow and we use this guiding principles, right? So what are the top 5 things lenders want to know, or what do we want to do with the cooperative business is, will we get repaid, right? Are we going to get repaid? Will we get repaid? All right, you kind of like, you get the idea of what I'm talking about. I was at the CCMA this last weekend, and I had a very interesting conversation with somebody about, a startup. And the person, they're in North Carolina, they're building something very, very unique, and it is all co-op based. And every time she spoke, she's like, I'm serious. I know what it means if we fail. We cannot fail. This is going to cost about, I think the total project is going to be about 60 million, and it's going to have, CLTs, co-op, a food co-op housing, affordable housing, all sorts of structures. They already have the land. I think the government is putting about $8 million in. And the reason why this is important is, she said, if we fail, people behind us, it will take 10 times of the amount of time that we have in this, that people would have to do to be able to get to where they have gotten to. So she was saying that it's important for them to do well. What do we look at? In a typical business, we'll look at the 5 C's of credit. And I'm going to say now that even if it is a co-op, we are still going to use or think about the 5 C's of credit. It's not going to change. So we're going to see if the people we're dealing with have the character to be able to do this. Do they have the capacity to pay back? Is there capital, which means that what have you put into the business? We don't like to lend more than 3 times the leverage, although sometimes you go to 6. That is technical, and we can get into that later on. Then collateral. Is there collateral that will support the business or the co-op in the event that they are not able to make the payment? And then the conditions, macro, micro. Do you have a feasibility study? I'm at the CDBA now, and the CDBA is an association of community development banks, and the number of times I have heard scenario planning is unbelievable, because every other week something comes up that they have to plan. I was talking to somebody yesterday that they were going to fund a business, and it was a day before the closing, and the borrower pulled out. Why did the borrower pull out? Because the cost of their building is going to, the cost of the project is going to increase. But guess what? They don't know by how much, because the tariffs, they don't know how much that's going to affect them. So that is one of the things, that are the perspectives that we look at, like what is going on in the economy right now. If somebody tells me, oh, they want to build a food co-op at this point, they want to, from the bottom up, build a food co-op, I am going to be very, very skeptical, because how do you do that? How do you do that in this period where planning is impossible? The only thing, so in every building, in every project, we always advise the borrower to have a 10% contingency plan in the event that something happens. But 10% doesn't make any sense right now, because at the end of the day, you don't know what the cost will be right now, unless you lock in the price and the guys are not going to sell and say, you know what, we can't. I mean, if I think it was Ford that came out, Ford, the car company, that came out recently and said they're throwing out their scenarios. They're not going to do scenario planning anymore because they can't do it. So, and this is affecting everybody. This is going to be a trickle-down thing, but again, I don't want to digress. So, because we are in a unique and phenomenal sector of this economy, I think there's the 6th, the 7th, and the 8th seeds of credit. And that to me is communication. So as co-op lenders, not only do we want you to communicate with us, nobody likes surprises, but we communicate amongst each other, with each other. So I'm on the phone with Gerardo. Again, think about it. I'm on Leaf's board. Gerardo is on NCV's board. I'm on KBC's board. We do this because investor-owned companies can do it too, but we do this because of the uniqueness of this co-op. And I think that when the thought leaders stick together, these 5 C's of credit should be expanded to include, communication, to include collaboration, and also to include cooperation, which is the principle 6, cooperation amongst cooperatives. Now, these are the factors that we also consider when we are looking at co-ops. Co-ops are significantly unique. And I'll give you an example. There's something called a key man. The key man is somebody that is tied to a business. So in the event that something happens in the business, you can hold that person accountable. Unfortunately, for a co-op, let's say a food co-op that has 1,300 members, who are you going to hold accountable? You know, there's no personal credit score. You have cooperative governance and cooperative management. You have a GM, you know, which is so based on what Scott was saying earlier on, he was asking or talking about risks that we have to mitigate when we're making these loans. One of the biggest risks right now in the co-op world is the GM level, because we have seen that there is a dearth of GMs that are qualified to run a food co-op, for example. You know, I'm using that because I'm sure everybody knows about that. But that is one of the risks that we have to mitigate. Then, in the capacity, we have member economic participation in the business, you know. Who are the people in there? Are the members participating? These are the things that we look at because this is a co-op. These are the differences between a co-op business, a typical co-op business, and an investor-owned business. When we think about the capital, member equity, we have 1,300 members. What is the percentage of the people that have equity in the co-op, number one? And then number two, let's again use food co-ops, just for an example. If your zip code is 20,000, 2000, right? And you have people in a zip code of 40,000 donating money to put an equity in your business. Those people are not going to be, they are members, but they're not going to be shopping members because they don't live in your zip area. They don't live in the area of where your business is. And as a lender in the co-op sector, one of the things that we look at is what would be the active participation within what percentage of the members would actively participate in the co-op. Not necessarily who has donated or who has equity in the business, but who would be going in and out every week, every other day, every 4 days to participate in the business. Because at the end of the day, it is not the equity that we're after, it is the sales and obviously the bottom line for everybody's benefit. So we look at that and we have percentages that we think of based on those numbers. I typically get a list of all the members and their zip codes. I don't need their names, I just need their member number and their zip codes to be able to say, okay, out of 1,000 people, 600, 700 people, 70% live in the area, and then maybe 40% of the 70% will shop at the store. And you know that there's no collateral. There's really no collateral in a lot of the businesses that we do. I was talking to somebody at the Grounded Solutions conference last week, and I said, oh, well, we're going to put a lien on all your business assets. And she laughed and she said, well, we don't have any assets. I know. I said, I know, but it is just the way things are. We will discount the collateral to a large extent. And then obviously there are, there are co-ops that thrive in certain areas, not necessarily because of the geographical location, but because of the networks and the support that they have. So the governments, universities, hospitals, places that, we know will support whatever co-op it is that you're forming. So those are the other things that we look at. Now, this is talking about NCB, but I'm going to stop here for now and have, first of all, ask if there are any questions, and then let Gerardo chime in. Any questions? Wow, that's good. Gerardo, do you have anything you would want to add?
Yeah, there are a few things I would like to add, but they can fall in the time when I'm making comments.
So I'll suggest that you start because we're at 11:40 now. We've already taken 40 minutes. So maybe you should just go ahead then.
Yeah, the I, I wanted to follow up with some comments about what Dami mentioned, and also has to do with a question that one of the questions at the beginning. One of the questions at the beginning was what sort of financing is there, right? And I think that was a very good question because financing can come from different sources, and the great example here we have with NCB, that is a bank and it's a regulated institution, and they have some parameters they need to meet, and that is one set of lenders. Then there are another set of lenders, which are the community development financial institutions. And these are entities that typically are much smaller than the banks, but on the other hand, can have some more flexibility in terms of some of those lending parameters that Dami was mentioning. And in many instances, we work together and we take the riskier part, that's called subordination, and the bank comes with the safer part that meets their needs, their credit risk parameter. Now, I'll mention this also as an illustration because we have used it as well, is this aspect of crowdfunding, which is when I think the best example of crowdfunding, even though it's not called crowdfunding, is the example of the food cooperatives. Typically, a food cooperative has a small food cooperative has between 2,000, 3,000 members. And some of those members make a loan to the cooperative, and that loan can normally range from $500 to a few $1,000s. So let's assume that 20 members make a $5,000 loan. Right there, the cooperative has $100,000 of capital that they can use. Now, that's the concept of crowdfunding. People coming together with relatively small amounts of money so that now when you have a large number of persons that are engaged with a project, then that can start to be meaningful, right? But all of that is in answer to that question on what are the financing sources, right? So one element I would say is to be aware of the spectrum of financial providers and the requirements of each one as well, right? Sometimes this can vary because in our case, for instance, in Massachusetts, we run what is called the Massachusetts Food Trust Program. And the aim of that program is to ensure that there is healthy food in low-income communities. And one of those types of healthy food outlets or grocery stores could be a food cooperative. So because we're running that program and we have support for the government for that program, we might have more flexibility to support a specific food co-op in Massachusetts. And when I say more flexibility, is with the rates, lower rates, and perhaps taking a little bit more risk, right? So that's the importance of surveying the map of what I would call financial providers to be aware of who they are and what could be the best fit, right? The second point, following what Dami also mentioned, is the aspect of the all of these sources want to be repaid. So all the aspect of what in the presentation Dami called the 5 C's of credit, they all play a role, and I would say they play a role across all of the different type of financing. But some of the vehicles may have more tolerance than others, but definitely at the end is a business, and it should have expectations. There should be expectations that the business will be sustainable. Now, as a third point, I wanted to share with you a few of the situations that have not gone well in our portfolio, just as an illustration of the things that one has to pay attention to. And so we have a client that is food co-op. I believe it was in North Carolina, but I'm not sure. And when they do the analysis to see if the co-op will have enough revenues, they do what is called a market study to see the population, the density, the characteristic, what could be what they call the typical value of a market, of a basket per client, and so on. And as part of that, they had, in that particular instance, they were counting on a relatively large housing project that was going to be like a couple of blocks from the food co-op. The two things happened there. One is that there were delays on that housing development, and the worst part was that there was some construction work that made it more difficult for clients to reach the food co-op, right? So those were unexpected things that they didn't expect, we didn't expect. And as a result, a beautiful food co-op had to close less than 2 years after it had opened, right? So this is an illustration in terms of the many outside factors that don't have to do with the business itself, but can affect the performance of the business. And that is why is the importance of what Dami mentioned, the contingency plan, or putting some aspect of contingency on the project. And there, particularly when it's a startup, and there is something that I always value a lot, and an expression, right? The expression is that think that it will take twice as long as what you think, and it will cost twice as much as what you think. right? I think keeping that in mind as a rule of thumb can be very helpful. Now, another situation that we had where we had to write off that loan was a loan to a worker cooperative, and it was a loan cooperative established initially by a Bolivian immigrant, and the co-op was to provide painting and cleaning services, right? And a recession hit that co-op, and that was before I joined LEAF. Actually, one of my tasks was to write off that loan. And when I went to meet the president of the co-op, this was in Rhode Island, to give him to get a status on what was the situation. He told me when the recession hit, the number of clients that we had diminished, and the co-op members couldn't wait until we had more clients. So the members of the worker co-op started leaving, right? The worker co-op, and then he said, until this morning we had only 2 co-op members. And this morning, I was told that I would have only 1 co-op member, which is me, because the other co-op member was my wife, and she told me at breakfast that she was no longer going to be a co-op member. Right? So it was obvious that these guys had to close. I think what happened there was that something that contributed to this is that the co-op requires a certain set of values, right? We have all heard of the 7 co-op principles and the belief in those principles, and seeing those principles as something that is an alternative to other economic models and wants to pursue. I think having that kind of understanding and so on gives more resiliency to the co-op members. In this case, I believe they were mainly oriented, viewing the co-op as an activity that would provide a paycheck, right? And as soon as the paycheck started getting tougher, they found other opportunities, right? So this has to do as well with governance, with the aspect of the persons being imbued in what is the spirit of the co-op, and I think that gives the co-op some more resiliency. And the third element, I think, which is also an illustration that I say sometimes the tough part of my job is to make sometimes the heart and the brain don't connect, right? Because it's a project that really, you say, this is something we should help, right? But the sustainability doesn't seem to be there. So the brain is saying, this is not sustainable. The heart says, I want to support this project, right? And how do you make those two, how do you balance those two? And I think I'll give you an illustration of a few projects that are happening now in the cooperative sector. Particularly the food co-op sector, is that there are many, typically the food co-ops were established in areas that had some, are we still here?
Yes. Yeah. And you were
Okay.
talking about food co-ops. Go ahead.
Okay, so the areas that had a certain amount of disposable income and so on, But that approach tended to exclude low-income urban areas. So co-op developers, co-op providers said, "Oh, this isn't right. We should also be covering these areas." And I think from a heart standpoint, that's the right thing to do, right? But sometimes when we need to look at the revenues of the co-op in that particular location, that can be the issue. So we have currently 2 loans that are in that situation that are to support food or grocery stores. One of them is a food co-op in the inner city, and again, from the standpoint of the heart, it's a beautiful. Both of them are beautiful projects, but they are struggling in terms of how to make revenues reach to the number they need to be sustainable, right? So I wanted to share this with you because the 2 aspects are very important, and I think on one hand, that the project, particularly as a cooperative, attracts a lot of goodwill and attention, and people want to support them. But it's also to pay attention to some of what I would call the business model, to make sure that it has a good chance, right? And yesterday, I was attending a conference and related to housing and nonprofit facilities, and there was someone that was from a childhood development center, and they were showing the construction of this beautiful expansion that they have done. And as part of thanking for the financing for this, she mentioned something that we have a very important responsibility, because every day the parents entrust us with what is the treasure in their lives, their children. Right? And so we have responsibility to do the best with that treasure that they are entrusting to us, their children. And I think in the case of lending also is the same, right? Whether it's a cooperative lender or a lender, we have a responsibility to make sure that the project is doable, is sustainable. As a lender, if the project doesn't go well, yeah, we don't like it and we need to write it off, but we continue our lives. However, for the borrower, if the borrower or the co-op members that put this together, if that is not the case, they have invested 3, 5, 6 years of efforts, and the project is not sustainable, right? So that gives us, I think, as both a cooperative developers and as a lenders, the responsibility of making sure that we're supporting good projects, because otherwise the real ones that will suffer the most are the persons that we're trying to help. So we're getting close to the hour, but I just wanted to share these observations.
Thanks, Gerardo. I love it when we talk about things that don't go well, because I think there's so much to learn, and it's not always you know, the topic of conversation, but it's really good to know. Yeah, do folks have questions for Dami or Gerardo? Anything that came up for you?
I have a question.
Well, thanks, Dami. And also Cynthia raised her hand, but go ahead.
Oh, sorry, Cynthia. No, go first. Okay.
Oh, thanks. So my question, I'm going to try to see if I can articulate it well, but I guess to some of the points that Gerardo and Dami both raised about kind of recognizing that cooperatives are first and foremost their businesses, and they need to have strong business plans, and we need to believe that they will be successful, and the people who have the greatest risk or taking the greatest risk when they fail are the people that are getting the finance or the loan. And I guess, like, personally, I've seen and been talking through a number of kind of failed examples lately, and I don't have insight into like the exact business plan that was in place. And these were largely like in food hub models that were both cooperative and also not cooperative models. But it seems like to some extent there is like part of the business plan included some sort of philanthropic funding in addition to revenue. And that was like maybe where the miss was, whether like they anticipated continued philanthropic funding that fell through, or just, you know, the climate shifted, or maybe the philanthropic funding wasn't. I'm not really sure. And I guess my question is like, to what extent in terms of like stacking different financing types, do you see like the role of philanthropic funding? Is there a certain point where you see something that is like heavily funded philanthropically that you think, oh, that's a risk. We don't want to, like this business might not be able to sustain itself on its own? Or is there like a way to weave the philanthropic funding in a way that still gives you kind of a sense of assurance that this business could still sustain, if that makes sense?
That makes a lot of sense. And before we try and answer that question, just want to tell everybody it's 12 o'clock. If you want to stay, that's fine. I have a couple more minutes, so I'm fine for staying, especially because my bosses are here. I need to make sure I'm compliant. But I'm going to take a quick stab at that. We don't like to be careful with this. I wanted to say we don't like to lend. That's not true. We like to lend, but we like to make sure that you're not severely or highly leveraged. Starting out as a food co-op, a new startup, or whatever it is that you want to start up as. And the reason is because of the pressure of the leverage, has just a lot of issues. I say that because we like you to get philanthropic funding. We love it. We like grants. We like things that will not be repaid. So if somebody told me, hey, we're most likely going to build a new space, I'm like, it's a lot of money coming out of the gate. You have to find a way. Tell somebody that is a member, ask them if they have a space that they can rent out for a while, and you can pay them in kind for the first 2 years. Look for something to do. Now, it depends on what. So we don't mind you. I would say we like to see the cap stack with philanthropic funding in it, but we also would follow through and see how much of that comes in year 2, year 3, year 4, and so on. And we will discount it. So in year 1, it is fine because it helps to start the business, start the co-op, get your feet wet, get out there, but it cannot be counted or it cannot be assumed to be part of the business because receiving donations is actually not your business. That's not how you're going to be able to. Sorry, cap stack is capital stack. Thank you very much, Noemi. I think it's cap stack is, where you get your sources of capital from, Yeah, so we like to see it. We just want to make sure that, and then it depends on the co-op. We can get into the technicalities later on, but if it's going to continue and it's going to be a source of income going forward, we are going to discount it. And I'll give you an example real quickly. Let's say you're a food co-op and by chance you have a housing co-op next to you, or a commercial property that you collect rent from. We will factor those in, but we'll also discount the income. Because while you own it today, you might sell it tomorrow. You know, while you own it today, something might happen to it tomorrow. So we discount it to say that that is not your core business. Your core business is getting inventory from the back and selling product through the front door. Gerardo, go ahead.
Yeah, no, my view is similar. I think the philanthropy is helpful, and particularly at the beginning, but what is important to keep in mind is, I believe most philanthropic sources, they don't want to keep supporting something forever, right? So they are happy to support it, to kickstart it, but the expectation is that there will be some plan to sustainability, at least for the type of projects that we see, right? And the problem comes when the first year one, year two, they get the support, perhaps year three. But if by that time they are not sustainable, philanthropy also takes a back seat and says, we have done in our part, right?
So my quick question, sorry, Cynthia, follow up?
That's thankful. That's helpful. Thank you.
All right. My questions, I think it was Lacey that talked about a maintenance co-op and a renting co-op. What's a renting co-op?
All right, so with our renting co-op, we have different properties that we own in Meadville. So those members that are part of the renting co-op, they are then in essence have monthly meetings so that they have like the democracy of voting for what they would like done with the property, such as putting in a garden, getting a grill, and then in essence with their rent that they pay, a part of it, then whatever is left over at the end of the year, they could then use that equity how they would like for the property in place.
Great. So it is a it's a commercial rental, housing rental property, or commercial
So
property, right?
it's actually not like big commercial. It would be like couple like single family or like a duplex like on Poplar Street. We have a lower and an upper apartment. South Main, we do have 4 households in there. That was the first renovation project. And then we actually have 3 homes on Prospect Street that would be hopefully then actually sold as part of like the self-help housing, home repair acquisition, that program. And then it would be a single family.
I'm impressed. I mean, that's I was kind of like thinking, oh, how is that different from housing co-op? But you guys, it's like a company that is buying properties and then renting out. That's awesome. That's
So we're a
awesome.
common land trust. That is actually why. So like the properties that we acquire, that's how the sustainability of being able to provide like the economic wealth. So therefore, when they sell, it's almost they have to do the pay it forward, sell it at like the market rate to another low or very low income family.
Okay. Thank you for that information.
Oh, you're welcome. Thank you.
Yeah, I just wanted to add for the group, right? And I think probably I speak for Dami as well. Noemi can share our emails and any questions and so on that, again, for time limitations, that will be happy to follow up or have a separate conversation.
Yep. Speak for me too.
Great. I'll
Thanks for
I'll
that
put
offer.
your emails in the chat right now. And yeah, thank you so much, Dami and Gerardo. This was really enlightening and informative. And I'm sure if people have follow-up questions, they can reach back out. But yeah, thank you so much. I really appreciate it. And Autumn put the link to the survey so you can give us some feedback and let us know what you thought. And we will see you again in 1 week at our next session. Thanks, everybody.
Thank you very much.